winning growth solutions in the fixed annuity market. So Steve, we're talking about the fixed annuities, growth solutions. What are some of the first things that we might think about when we think about growth in the fixed market?
Mm-hmm. Yeah, I think the first thing that comes to mind is probably the easiest annuity probably to understand would be the multi-year guarantee annuity, or a MYGA, where you get a fixed interest rate for a fixed term. And you're usually, the common one's 5 years, and right now they're going for around 5.5%. So the client can expect that specific interest rate each year, and it grows tax deferred. So it's a little bit different than a CD, but it's really common for clients to understand it because it's so similar to how a CD works.
Right. And we love MYGAs. We often joke that they're the low-lying fruit, that they're the, what do we call them? The gateway drug to the annuity business. Yes. Yep. Because they're simple, they're easy to understand. They're a lot like a CD at a bank that many customers understand. And so, they're fairly easy to sell and understand. That helps them an awful lot. So if we move from the MYGA, the simplest and easiest, probably the most conservative approach, we probably step into the fixed index annuity market. We start stepping into fixed, right?
Yeah, so you get the FIA, fixed index annuities. They're different in that their growth or interest rate credit to their account is based on how a certain index may perform, or multiple indexes. Something like an S&P 500 index or a NASDAQ index, something that a client can follow along with on how the market's performing, but it knows that it can't lose any money based on how the market performs, but will get a portion of the growth.
Yeah, and that's the key, that the rate's not guaranteed, that if the index performs, they could make a credit, but if the index doesn't perform, the good news is they don't lose, but they might get a zero. And, people need to understand that they can and probably will get zeros.
Yep, that's right. So, that there's another alternative way with thinking of a fixed index annuity is one that maybe comes with a bonus. It's kind of provides a level of certainty for the client, knowing that despite maybe a year where the market doesn't do well and you get a zero in your interest that year, you had a bonus when you first initially got the contract. So we see bonuses range from up to 20% with fees, some around 14% without fees. We even have some that are 5-year fixed index annuities that have an up to an 8% bonus. So that's a little bit more newer on the market. So those are some nice bonuses that can really help cover maybe surrender charges and other annuities that the money's coming from.
Yeah.
Or maybe the clients experience some market losses.
Right. Yeah, bonus annuities have definitely kind of come back. There was a lull. They've been around for a very long time, but there was a period of time there just a few years ago where they weren't very common. Right. And now they've kind of come back in a big way. And we've seen a lot of innovation again in the industry with the way the carriers are making these bonuses work. And they can make a great deal of sense. I mean, the nicest thing about a bonus is the level of certainty that someone gets. Yeah. Is that no matter what happens, if they get that bonus, they know that they have it. And it can often make a big difference if they're impaired or wounded a little bit coming from where they're coming. Maybe they had a surrender charge or a large market loss. And a bonus can go a long way towards helping someone maybe recover some of what they lost, on their way into a certain product. So bonuses definitely are something that contributes significantly to the options that we have for people in the growth market.
Sure. Yep. And then sometimes some things that make fixed index annuities maybe a little bit more difficult to understand for agents and clients versus the MYGAs we probably started off this conversation with is the indexes are kind of have their growth is based on maybe a cap or a participation rate that many of you agents have heard. Caps, basically, you have a cap on your growth, maybe 4 or 5%, and that's the most you can get from how that index performs that year. Participation rates, sometimes they call those uncapped gains or options there, where you get a percentage of the growth, no matter how much that interest growth was for that index that year. So that a lot of clients like that idea of uncapped strategies.
Yes, an uncapped strategy is pretty popular. And briefly you talked about caps a little bit in pars. So if the market, let's say the S&P did 10% and they have a 7% cap, they'd earn 7%, or they earn up to 7. If it did 10, they'd get 7. If it only did 5, they'd get 5.
Yeah.
But that's how the cap works. Now the participation rate, if the participation was 50%, which probably would be a pretty good par rate on an S&P, let's say, and the index again did 10%, they'd get a 5% credit, 50% of that 10%.
Right.
So that's kind of how the par rate works, and that can make a difference. On the other hand, if the market does 0 or negative 20, they get 0.
Yep.
The good news is they don't go down.
No, that's right.
But they get 0, and that's a good thing when the market's gone down, significantly.
Yeah, I mean, because you can get illustrated values from us for all different carriers, and we'll see a wide range of growth over, say, a 10-year hypothetical period, where some carriers, their illustrations will show double the growth, some will triple or even quadruple. So it's really kind of important to manage your clients' expectations on knowing that there are going to be years that are going to have zeros, and there's going to be other years you're going to have some good growth. But knowing that not every year is gonna, you're not gonna set the world on fire with high interest rates growth every year. There's gonna be some years where you have zero, and so zero is the hero, as the common phrase you hear often with fixed index annuities.
Yeah. And that is important, particularly the closer people get to retirement, the more important the return of their money is than the return on their money. And that's widely understood. And so that's why, the no downside market risk, the zero is your hero is such a compelling value proposition for so many people. We thank you for joining us today. If you would, please take a moment to subscribe to our channel and hit the notification bell below so that you'll be notified every time we come out with a new Selling Life and Annuity video. And if you would be so kind as to like, comment, and share this, we'd appreciate it very much. And with that, thanks for joining us and happy selling.